Now, your host, Michael Cohen, with the Capital City Recap on More Compelling Talk Radio, 1320 WILS.
And welcome back, everyone. I'm Joanne, sitting in for Michael this week. Well, the Dow was down today nearly 1,100 points before rebounding somewhat. Actually came within 50 points of the start. Then it plunged yet again better than 500 points. But how has that affected our retirement investments? Is it time to sell or buy or basically do nothing? Joining us now is financial strategist Clark Hodges. Thanks, Clark, for being here.
Good to be on, Joanne. How are you doing this evening?
Well, I am doing pretty well. A little bit nervous about that 401k. The Asian markets are about to open, and what are we expecting, do you think?
You know, it's a roller coaster. It's probably going to be that way. I think the nice thing about being here is that of all the markets that will be a little bit more realistic in reaction, I think ours is the first one that will come back to normal. And so I'm glad for that. You could have Asia be down big overnight and still have ours up tomorrow. So I'm not too concerned about what it's going to open up at this evening.
Well, how long do you think this is going to last? I mean, the bottom line is it doesn't sound like the worst is over yet.
It's really hard to tell. No one can predict, obviously, where the thing goes from here. The thing that you need to focus on is valuations. And it's one of the things we put out today from our firm was, you know, valuations before this pullback were not expensive. You know, price earnings multiples on companies that we invested in were not like they were in the late 90s when some companies were trading with zero earnings. Some companies were trading at $100 a share, so they're trading, you know, so high from a price earnings multiple. And today we're just not that expensive. So when you see companies come down, and with the passive investing that goes on, you're going to have a lot of good quality names go on sale, and you're going to be able to pick some up if you're so inclined. And that's individual securities. In your 401k, you know, you may want to go out and buy something today, but you're not able to do that in the 401k. You might be able to change your approach to what style of investing you're doing, but you can't take advantage and buy individual securities in your 401k by most standards.
So if you had a 401k and you're nearing a retirement age, what is your best advice? To do absolutely nothing?
Today I would do nothing. You've had a pullback, a substantial percentage pullback. So your 401k has pulled back in value. And you don't want to sell on the day that the thing is in panic mode. What you'd rather do, my best advice, is if you make the decision that you want to get out of some things because of risk, give it a few months to go back up somewhat and get to a valuation that you can live with. Because just selling it on the day when everything's panic selling, you're going to get a really bad fill. And you never know what the rest of the week could hold, and for that matter, the rest of the year. And so maybe wait to get a little bump back up in your valuation.
So that's why it's so important, I think, for seniors to have a bank account, if you will, to be able to live off of, so that they don't have to touch their retirement accounts in a situation like this, where it's probably best to let it ride as long as you can.
I think it is. It depends on your risk tolerance. My father was 80 years old, and he was still buying growthy type things with his money. And that's just the way he wanted it. He wasn't into going to dividend yield or bond type portfolios for himself. So it just depends on what kind of risk you're willing to take as an individual. And I think one thing that I will say, most people's problem late in life is going to be outliving their money. And used to be, if you're 60 years old, the recommendation from Wall Street was go to bonds, get real conservative, and go to dividend yield. And I'm not so sure that today at 70 years old you should even do that, because most people, by and large, are living longer. So a little bit of growth isn't bad. Now, not all of it needs to be in growth at 70 years old, but a little bit of growth mixed in there isn't a bad idea, I don't think.
Will this uncertainty, though, start to hit the bond market?
I think interest rates have to go up for the bond market to be a scary investment. Most people look at the bonds as a very, very conservative, very, very safe investment based on what's happened the last 10 and 15 years. When interest rates go up, people who check their valuations of their bonds will see the bond value go down, and that will scare some people. And they'll think, why is this down? I thought this was a very safe investment, and interest rates have ticked up 2 points, and my value's gone down 20%, and I didn't even think that was an option to even happen. So I think interest rates need to go up for that to happen.
Well, didn't the Fed really kind of blow its chance to raise interest rates at one point a few years back, that probably it was the time to do it? Now, I mean, now I can't imagine anybody raising any interest rates for at least another year.
I can't either, based on what the market's done the last 3 days. I agree 100% with what you're saying. I think the September meeting, that was such a question mark for a lot of people, and one of the reasons the market fell last week was the Fed minutes were released, and there seemed to be no direction. Of course, the market hates uncertainty. And so, but I'm like you. I can't imagine interest rates going up here in September because the market's down to where it is, and the U.S. economy, although growing very slowly, the consumer hadn't kicked in yet. And most people think the consumer is going to lead the economy going forward for the next few years based upon having more money in their pocketbook from gas prices going down. But that just hasn't really happened yet. And people think it still will happen, but it just hadn't happened yet.
Does government need to get out of the way of these businesses and let them grow jobs and the economy?
Yeah, I think government policies hurt job growth. The one that sticks out of my mind is Obamacare. If you're forcing employees to pay for this, and everybody's, businesses are going to say, look, we're in business to make profit, and if our cost basis goes up because the government's making us do some sort of policy, we'll just lay people off. Minimum wage going up, we'll just lay people off. If you're going to make me pay my minimum wage level people more money, and I think that it's going to hurt my bottom line, as a business owner, you're going to take steps to make a profit, and that's what you're in business to do. And one of the things I don't like about, the current administration is that's a bad thing to most people because of what the current administration said. If you make a profit, hey, you should give us a big portion of that because we're not out here working. Well, that's just not how it works. They're making a profit. That's why they're in business.
Well, yeah, and you're seeing American companies making a profit by investing in other countries. And that has to be a red flag as well, that, if you're making it so difficult to do business in this country, then there's something wrong. We need the jobs here, not elsewhere.
No doubt.
All right, when we're on the line with Clark Hodges, he is a nationally known financial strategist. But I got to know, I got a pit in my stomach when I turned on the TV this morning and saw the 1,000-point drop. What was your first reaction as somebody who's, you deal with the ups and downs all the time? Were you ready to deal with this?
I was. I've grown up around this business. My father was in it for 55 years. I remember 1987. I was in college, but I remember 87 being in my father's office and seeing the drama on people's face, the worry on people's face in that office. And so you do recognize that these are part of the game. These days do happen, but that, clear heads will prevail, and just be smart and remember that good companies will go down in price today, but they're not doing anything wrong. They're not losing revenue or losing earnings. They're just going down because the whole market's going down. So there's an opportunity, by and large, to find something. And I'm not a huge worrier-type person. I'm a little bit more easygoing. When I saw that the Dow at 5 this morning was going to be down about 400 points, my eyebrows raised. And it kept getting worse through the morning, even before the market opened. And a few minutes before the market opened, it was over 800. And I was like, wow, this is really some kind of day we're going to have. And then, of course, within the first few minutes, it goes down over 1,000. And it was just drama, and it was dramatic, and it was scary, and it is easy to say and hard to do, go out and buy today because there's opportunity out there, but it's something that I think in this business, especially kind of growing up around it, you kind of know what to expect, and this is part of it, and you just move on.
While some people lost a lot of money, others gained some. I mean, Apple was a great deal for those. Home Depot increased in value as well. I mean, if you were there and looking to spend, and as you mentioned, if you've got, guts of steel and think whatever, I can do this, that was a time to certainly be picking up some stocks. But, for the most part, I think people are more concerned about, retirement accounts and kind of being held hostage with portfolios that they can't really make decisions day to day on. But I'm hearing, and perhaps you could confirm or deny that we lost about $6,000 on average in the 401k. But when you take that into consideration, what was lost back in 2009, we gained well over what we lost. Is that the case or no?
Yeah, based on being at the low and then what it came back up to, yeah, we've outdone what we lost in the recession of 08 and 09. Depends on the valuation of the 401k. Obviously, $6,000 on a $100,000 IRA isn't that bad of a deal, given the panic that's been going on the last 3 trading days. The nice thing about retirement accounts and 401k accounts, which is that they're not margined. A lot of people invest in the stock market by leverage, and they'll, want to buy something that's an investment of $50,000, but they only put up $25,000 and borrow the rest on margin. And that's a bad scenario to have when the market goes against you and you're liable to have a margin call, or they call you up and say, hey, you owe us 20 grand. And by the way, you don't get anything for that. You just get back to even. Mm-hmm. So it's nice that 401k assets aren't marginable. Hopefully people don't borrow against their 401k. And I know a lot of people do that, but that would be a negative too, to see your value go down $6,000 today, and also knowing that you have some outstanding loan out on your 401k, so that people can, do big ticket items is kind of what usually happens.
Now, what if, we do have some retirees out there who are listening and saying, look, I need money. If I don't borrow against my retirement account, or if I have to wait for an extended period of time to actually cash out so that I don't take quite a big as a hit that I did today, what is your recommendation for where they should get that money?
Well, most people that are of retirement age and in their retirement, and there's a regularly scheduled, if you want it, a regularly scheduled liquidation from a retirement account that you can say once a year, give me this money, or once a month, give me this amount of money. And hopefully if you get it once a year, it's enough money that you're saying, okay, some of this needs to go into cash for such an event where I do need cash, and just have that part of it liquid for your everyday living expenses. You just have to plan that out as an individual based on your needs. But as a retiree at a certain age, you are allowed to start taking money out without penalty. And at a certain age, you're required to take some money out based on your life expectancy. All
right. Any other advice you have for investors? I mean, you mentioned it's basically temperament. If you can do the harsh stuff, go for it. If you're not into aggressive trading, then maybe you do something that's on the milder side.
Just know that there's always going to be some worry out there. Something's going to cause the market a little bit of trepidation. But in the long run, long-term investors make money and traders don't. So just stay the course and don't panic, and stick to what your objectives were going into the investment.
All right, Clark, if people need more information about how to get in touch with you, is there a website they could go to?
Yes, our website is hodgescapital.com.
All right, Clark Hodges, thank you so much for being here. I appreciate it.
Thanks, Joanne. Good to talk to you again.
You take care now.